Hello, fellow value investors. I'm coming at you with another book review slash overview slash summary thing, this time for The Most Important Thing by Howard Marks. Before getting into that, though, I want to thank you guys for how much love the videos I already did got. I made the channel a month ago, and it's already doing better than my main channel. This number is crazy. You know how YouTubers are always like, only 3% of you are subscribed? Well, I got 154 subscribers off of 475 viewers. So 33% of the people who have viewed my videos decided to click that subscribe button. That's crazy to me, and I appreciate it, and that's all the motivation I need to keep this channel going. So thank you guys, appreciate it. Now on to the video. Okay, so let's start here. What's the book? What's the book about? So the book, it's a mix of Howard Marks' thoughts on investing, punctuated with memos he wrote to his investors through the years that he was running the fund, and occasionally excerpts from books that he likes. So the core premise is investing is an art. It's not a science. You can't do it with an algorithm. And importantly, you can't just focus on one and most important thing. There are 20 chapters, and everyone is, this thing is the most important thing. There are 20 most important things, and you need to be doing all of them. You can't just be doing the one most important thing. Anyone tells you there's one thing is wrong. And it's kind of a survival guide. It teaches you that you need to be participating in the gains of the market, but you need to be able to sidestep some of the market's worst moments. And that's how he got his outperformance done. Once again, he outperformed during the dot-com bubble and during the 2008 financial crisis. So here's a chart. I'm going to have some charts from him, but here's a chart I made. This is the number of passages from his memos by year. So you can see that there's a couple here in 91, around there, 95. There's a few. There's a giant spike before the dot-com bubble. There's a giant spike before the 2008 crisis. This book was published right after the 2008 financial crisis, and people wanted to hear the thoughts from a guy who dodged the fall and then jumped in and bought the dip. And who is the guy? The guy is Howard Marks. I talked about him a little in my last video. He's the co-founder and co-chairman of Oaktree Capital. He's a big deep value investing and a big distressed debt guy. He did a lot in the bond market, buying bonds for companies that could be going bankrupt that he didn't think would go bankrupt, bonds that other people didn't want to touch and were trading for pennies on the dollar. During the 2008 financial crisis, when all these hedge funds were getting margin called and selling their CDs for pennies on the dollar, he was one of the people. He stepped in. He said, okay, you guys are trying to sell these things for 20 cents on the dollar, and they are garbage, but maybe they're worth like 40 or 50 cents on the dollar. And he would buy them up at 20 or 10 or 15 cents on the dollar. And he had the liquidity to hold on while everyone else was being margin called and wait for them to return to some sense of true value. He got net returns of 19% a year. So it was basically doubling the index. And probably during that time, because the end for this was 2010, the index is probably doing worse than we would say it is, where it's 8% a year, right? He was doing 19. We already talked about his trade. He's highly respected by Warren Buffett and others. If we go back here, Warren Buffett provided a quote on the book. This is That Rarity, a useful book by Warren Buffett. And any book Warren Buffett tells me to read, I will go and read. So let's go on to the first of his most important things. I only picked out 10 of them. There are 20 in the book. Some of them overlap. I didn't want to do 20 or this would be a 2-hour video. So the first one, second level thinking. So the first thing is second level thinking. His idea is basically that the crowd is the market. And if you want to beat the market, you can't be doing what the crowd's doing. You have to be able to think a few moves ahead. You can't just look at something on face value. So an example, and we'll give some quotes, but an example is a first level thinker will say, it's a good company, so let's buy the stock. Where a second level thinker, he says, would say, everyone thinks it's a good company, so it's overpriced, so let's sell it. If you're doing the same thing everyone else is doing, you're not going to beat the market. You're just going to match the market at best. So here's some quotes that come from the book. First level thinkers say it's a good company, let's buy the stock. Second level thinkers say it's a good company, but everyone else thinks it's a great company and it's not, so the stock's overrated and overpriced. Let's sell. First level thinking says the outlook calls for low growth and rising inflation. Let's dump our stock. Second level thinking says the outlook stinks, but everyone else is selling in panic. We should buy. First level thinking says I think the company's earnings will fall. Sell. Second level thinking says I think the company's earnings will fall less than people expect, and the pleasant surprise will lift the stock. Buy. So I think that kind of paints his general picture of you can look at it and say it's bad, but everyone else knows it's bad, and you need to play off of that information. The forecast can be bad, but if you know that everyone else is forecasting it to be very bad and you're only forecasting it to be a little bad, that's actually a buying opportunity in Howard Marks' mind. So first level thinkers think the same way other first level thinkers do about the same things, and they generally reach the same conclusions. By definition, this can't be the route to superior results. All investors can't beat the market, since collectively they are the market. So I think this repeats that same point. If you're trying to beat people, you can't just do what they're all doing. You can't follow the crowd in or out. You should be going against the crowd. The problem is that extraordinary performance comes only from correct non-consensus forecasts, but non-consensus forecasts are hard to make correctly and hard to act on. You can't do the same things others do and expect to outperform. Unconventionality shouldn't be a goal in itself, but rather a way of thinking. In order to distinguish yourself from others, it helps to have ideas that are different and to process those ideas differently. So he's saying you have to start at trying to think differently than others, and it's like a muscle you have to work on almost, to be thinking of things in ways others aren't. It's something currently I work on, and there are a lot of these where he even says nonsense forecasts are hard to make correctly, hard to act on. I've had some ideas where I'm like, I can make a big swing at this, but I held back. I'm still early in my investing career. I'm still making sure that I can trust that instinct. And he's saying you should work on developing that instinct. So the second most important thing that he says we all need to learn is intrinsic value. It's a fundamental, undeniable truth of value investing that price is what you pay and value is what you get. You need to have an accurate and deeply researched estimate of a stock's intrinsic value, and without it, you're just guessing. And these are both things I talk about all the time. I think I say that all the time. If you can't value a stock without knowing what other people are paying, you're just totally lost in the woods. And once you can value a stock without knowing what other people are paying, everything else just becomes so clear. And then he says the anchor of safety is price. No asset is so good that it can't become a bad investment if bought at too high a price. So any investment, there is a price that it would be good at. The stock you hate most in the world, if someone offered you that company for $1 to buy the whole company, it would be good. Probably. There's almost nothing that's worth negative. There's some price that anything is good at, and equally there's some price that anything is bad at. Even the best companies in the world, let's just say Nvidia, right? Nvidia maybe I think is a good price at 4 trillion, but 40 trillion, it wouldn't make sense. You have to be able to look at an investment and know that if you took away a zero from its price, that you would be putting a second mortgage on your house and buying it. And if you added a zero, you would sell it all instantly, right? Because you know its intrinsic value. It makes everything clear. And that's why the second thing he says is the most important thing. So here's some excerpts from his section about intrinsic value. To value investors, an asset isn't an ephemeral concept you invest in because you think it's attractive or think others will find it attractive. It's a tangible object that should have an intrinsic value, capable of being ascertained, and if it can be bought below its intrinsic value, you might consider doing so. Thus, intelligent investing has to be built on estimates of intrinsic value. Those estimates must be derived rigorously and based on all of the available information. So it's another thing that he kind of nails home here is that the more work you put into finding an intrinsic value, the more factors you can factor into your analysis, the better. The closer you'll come to the intrinsic value, the less likely you are to be surprised also and suddenly doubt your value. You can come up with a value by just glancing at stuff. And in the last video, maybe I did a 5-minute glance at each of those companies, but I've looked at each of those companies for probably 5 or 6 hours going through financials and all that. And these hedge funds, they look through them for hundreds or thousands of hours before pulling the trigger. Equally, this is why Munger, I don't think that Marx would support it, but this is why Munger is against diversification. This is why some of the people in the last video are against it, because it's easier to do this deep dive on 5 companies than it is to do on 500, right? So another quote. Value investors buy stocks, even those whose intrinsic value may show little growth in the future, out of a conviction that the current value is high relative to the current price. Growth investors buy stocks, even those whose current value is low relative to their current price, because they believe the value will grow fast enough in the future to produce substantial appreciation. Thus, it seems to me the choice isn't really between value and growth, but between value today and value tomorrow. This is another thing I'm big on. I would consider consider myself more of like a growth value, growth at a reasonable price investor. And this is his point. They are both value investing. People say growth investing is like the opposite of value investing. No, it is not. All companies here, including the growth. He actually talks after this, and I couldn't include the whole thing. Even the ones that you're buying on today's value, you still have to factor in tomorrow's value too. If they're in a debt spiral, right, its value will be lower next year. So the negative growth needs to impact it, and you need to have some forecast. The final quote I'll give. It's hard to consistently do the right thing as an investor, but it's impossible to consistently do the right thing at the right time. The most we value investors can hope for is to be right about an asset's value and buy when it's available for less. But doing so today certainly doesn't mean you're going to start making money tomorrow. A firmly held view on value can help you cope with this disconnect. This is another thing we talked about a lot in the Richer, Wiser, Happier one. Almost all of them say you can be right, but you have to be willing to give it enough time to prove out that you're right. Just being right isn't enough if you're not willing to hold for 1 or 3 or 5 or 10 years and have conviction that you are right and wait for the weighing machine of the market to catch up to you. So on to the next. So the next of the most important things we're going to talk about, and once again, we're only doing 10 of the 20. He actually has 3 chapters dedicated to risk, but we're going to do understanding risk, which is one of them. He says academics define risk as volatility or beta, right? We would call it. He strongly disagrees, and this is a fundamental of value investing to me. Munger disagrees, Buffett disagrees, Graham disagrees, and now Howard Marks disagrees. The reality of investing is that real risk is the probability of permanent loss of capital, right? If something moves more than the market every day, if every day the market moves 1%, the stock moves 5%, but I think it has no real risk of permanent loss of capital, then that's fine. Just because people are very uncertain about its price, but if I'm very confident it will eventually go up, even if we're all unconfident about the price it should be today, that's much less risky than something that could go to 0 or could 10x, right? High returns don't necessarily mean risk was low. They often just mean that a highly risky bet happened to pay off this time. And highly risky bets do pay off all the time. There's actually a quote way further down that goes into this that I really loved, even though he was just quoting Buffett. But okay, so here's some excerpts from this section. Investing consists of exactly one thing, dealing with the future. And because none of us can know the future with certainty, risk is inescapable. Thus, dealing with the risk is an essential, I think the essential element in investing. It's not hard to find investments that might go up. If you can find enough of these, you'll have moved in the right direction. But you're unlikely to succeed for long if you haven't dealt explicitly with risk. The first step consists of understanding it. The second step is recognizing when it's high. And the critical final step is controlling it. So those are his 3 steps for dealing with risk. Understanding what risk is, recognizing when an asset or the market is risky, and then taking steps to control it when risk is high. This is why I have some assets when I think the market's overpriced that I don't think will crash when the market crashes, and then I can swap them out and buy the volatile assets. So I'm holding some low beta assets, and if the market crashes, I can exchange them for high beta assets and get more of the recovery than I did of the dip, right? You can have cash in reserves. You can just have stable compounders that are going nowhere. You can have consumer cyclical, whatever. You can have assets if you think that a crash is likely that do well in crashes. And if the crash already happened, do you need those anymore? You can sell those when everyone's running away into them and then buy into all the things that they ran away from, buy them up for cheap and catch the recovery. But I mean, maybe some of them crashed for real good reasons. Who knows? Okay, another. Theory says high return is associated with high risk because the former exists to compensate for the latter. So he's saying that high return is there to compensate for high risk. But pragmatic value investors feel just the opposite. They believe high return and low risk can be achieved simultaneously by buying things for less than they're worth. In the same way, overpaying implies both low risk low return and high risk. Sorry, I butchered that one. This is another thing that I talk about and Graham talks about, right? There are very few things in the world that can give you low risk and high return, but buying an asset at a low price is one of them. Every time a stock's price goes down, it is now at lower risk and higher reward to own that, assuming that nothing massively fundamental has changed. The government's not stepped in and shooting them in the head, or some new competitors stepped in, right? The lower the price is, the higher your reward and the lower your risk. Whereas he says that academics would define it the other way, where higher risk and it always brings higher reward, lower risk always brings lower reward. And they would say if a stock's price drops 20%, it just got more risky to own because it's more volatile. Where value investors say that it just got 20% less risky to hold and 20% higher reward to hold. So the final one. There's a big difference between probability and outcome. Probable things fail to happen and improbable things happen all the time. That's one of the most important things you can know about investment risk. So he's saying that these 1% risks can happen sometimes. There's always people who are betting on 1% outcomes, and 1% of them will be right, and it'll look like they were geniuses, but they might have just been doing something incredibly risky and be the survivors. So here's some graphs that he showed that I actually really liked. So on the left, he shows a traditional risk versus reward or risk return graph that they might show you in a school, that if you're taking zero risk, you're getting like a 3% return, you're buying treasury bonds or something. And if you do some crazy risk, then you're getting on a 30% reward, right? You're getting this massive reward for taking the risk. And it makes it look like, hey, well, if you just take more risk, you get more reward. But instead, he shows these kind of standard distribution bell curves overlaid over this. You could kind of view it as like one big sweeping cone, but the farther down this risk thing, yes, the lower your reward, but also the lower the deviation. So down at the zero risk, you're getting exactly what you pay for. If you buy a treasury bond, there's no deviation, basically, as long as you hold it the whole time, don't trade in between. You know exactly what you're going to get. Maybe the first one you're buying some like super boring consumer staple stock or something like that, insurance, bank, I don't know, and the deviation's pretty small. You're not taking a lot of risk. You're getting some more reward. You might get a little more than you expected. You might get a little less than you expected. Next up, maybe is just regular common stock buying the index fund, right? You're getting, on average, higher return, but the standard deviation is lower. You could actually do worse than that treasury bond maybe could have. That's a potential there if you get the bottom end of that. And all the way out at the end, you're buying these massively risky things. There is extra reward to compensate you for the risk, but there's the chance of you going way up here and 10xing your money. But there's also the risk of you down here. Maybe you're leveraged. Maybe you're going negative. You're losing. You're losing money now. So that's how he wants you to view it as. It's these kind of bell curves, and the first line is just tracking the standard where the middle of that bell curve is, but there's a whole bell curve, and the variability of the outcomes grows and expands as you get further up this risk reward curve. So on to number 4. So number 4 is controlling risk. He says anyone can make money in a raging bull market. It's something he kind of drills home in almost every chapter that, in a bull market, everyone's winning. Everyone feels like a genius. The true test of a great investor is how they handle downturns. The primary way to control risk is by buying assets for significantly less than their intrinsic value, margin of safety. We'll talk about this more and more as we go. Risk control is invisible in good times, but saves you from total financial ruin in bad times. So here, we have this picture of this knight in a sunny day. It's a party, but he's still in his armor, ready for shit to go down. So here's some excerpts. The first one's pretty big. High absolute return is much more recognizable and titillating than superior risk-adjusted performance. That's why it's high-returning investors who get their pictures in the papers. And once again, this is why he's getting his pictures in the paper after the 2008 financial crisis. Since it's hard to gauge risk and risk-adjusted performance, even after the fact, and since the importance of managing risk is widely underappreciated, investors rarely gain recognition for having done a great job in this regard. regard. That's especially true in good times. But in my opinion, great investors are those who take risks that are less than commensurate with the returns they earn. They may produce moderate return with low risk or high returns with moderate risk, but achieving high returns with high risk means very little unless you can do it for many years, in which case that perceived high risk either wasn't really high or was exceptionally well managed. So I'll actually show some more graphs that go over this idea of his, but it's a big thing he talks about in this chapter. I don't know if any of the quotes cover it too much, where he talks about even in hindsight, it's hard to figure out how risky an investment was. So it's really hard to figure out how risky an investment is in the present or in the future, when if we look back 10 years, it's actually pretty hard to figure out if someone's portfolio was high risk. In this case, he's saying, in which case the perceived high risk either wasn't really high or was exceptionally well managed. Even in hindsight, it's hard to tell. Next quote. Likewise, loss is what happens when risk meets adversity. So he's saying that sometimes you take a lot of risk and the thing just doesn't come along that exposes the risk. So loss is what happens when the risk meets the thing that exposes the risk. Sorry. Risk is the potential for loss if things go wrong. As long as things go well, loss does not arise. Risk gives rise to loss only when negative events occur in the environment. We must remember that when the environment is salutary, that it is only one of the environments that could have materialized that day or that year. The fact that the environment wasn't negative does not mean that it could not have been negative. Thus, the fact that the environment wasn't negative doesn't mean risk control wasn't desirable, even though, as things turned out, it wasn't needed at the time. So you always have to be controlling for risks, understanding a lot of them aren't going to happen. But you need to feel comfortable that if they did happen, you've anticipated them and you're ready and your portfolio is prepared. He believes in a sort of all-weather portfolio. He talks about in a later section. It's an outstanding accomplishment to achieve the same return as the risk bears and do so with less risk. But most of the time, it's a subtle, hidden accomplishment that can only be appreciated through sophisticated judgments. And that brings us to these graphs of his. His graph showing investment success. So here we are again with the risk return. And he is saying here are two successful methods of investing. And it's actually kind of the same. You're just looking at a different reference point. But so if you're taking the same risk as the benchmark, but you get outstanding returns compared to the benchmark, that is considered value added according to him. That means you did well. Likewise, if you do as well as the benchmark while taking on a lot less risk, he also considers that to be very good. This is something I actually worry about. I worry that maybe I'm actually not over here, but maybe I'm just over here, because I do beat my benchmark, but maybe I'm just taking on more risk and I'm just getting the commensurate returns. And we'll see in a bear market if my strategy plays out, if the excess risk I'm taking on is commensurate with the excess returns I receive, or if I end up giving it all back during a crash. And that's kind of what he's implying. You need to be worried about that. You need to be trying to be up here and not just over here. You need to be here and not just like down here, right? So you being a good investor will put you above this line, this midline, and you being a bad investor will put you below this line. And you want to make sure you're above this line, not just further along the line or even below the line, right? You could be beating your benchmark, but over here, and that would mean you're doing a bad job. So that's all he has to say about risk for the moment. On to the market pendulum. And that's an analogy he uses to kind of visualize his concept of market cycles. You're always swinging between fear and greed. If you're in extreme fear, you're eventually going to go to extreme greed. The market can't just stay here. The market just can't sit here. Maybe if there was literally nothing happening, they could stay here, but you're almost always back and forth. He says the market psychology swings relentlessly like a pendulum between two extremes: euphoria, depression, fear, greed, whatever. The pendulum rarely sits in the middle. You're rarely at fair value, and the swings themselves are what can create the mispricings that a value investor is looking for to buy or sell. In the second level thinking thing, he was talking a lot, if everyone else is selling, you want to be buying because there's mispricings in that direction. Probably if everyone's buying, the mispricings probably in the other direction, and you probably want to be selling. So here are some excerpts from this section. The mood swings of the securities market resemble the movement of a pendulum. Although the midpoint of its arc best describes the location of the pendulum on average, it actually spends very little of its time there. Instead, it is almost always swinging toward or away from the extremes of its arc. But whenever the pendulum is near either extreme, it is inevitable that it will move back towards the midpoint sooner or later. In fact, it is the movement towards an extreme itself that supplies the energy for the swing back. So that's him describing his concept of this pendulum. So the pendulum swing regarding attitudes towards risk is one of the most powerful of all. In fact, I've recently boiled down the main risks in investing to two: the risk of losing money and the risk of missing opportunity. It's possible to largely eliminate either one, but not both. In an ideal world, investors would balance these two concerns, but from time to time, at the extremes of the pendulum swing, one or the other predominates. So he's saying basically at one end that you've maximized your risk of losing money if it's in a super greed, if you're in, and at the other side, everyone's maximizing the risk of missing opportunities. People are much more willing to either leave money on the table or to ignore risk at either side of the pendulum. So the final one. Very early in my career, a veteran investor told me about the three stages of a bull market. Now I'll share them with you. The first, when a few forward-looking people begin to believe things will get better. The second, when most investors realize improvement is actually taking place. And third, when everyone concludes things will get better forever. And then he proposes his own a few pages later. I couldn't include it, of his three stages of a bear market. And it's basically this in inverse. When a few forward-looking people begin to think that things are going to get worse or that the market's overpriced, right? The second is when everyone starts to get on board and think that the market might be overpriced. And then the third is when everyone thinks that the market's overpriced, that's going down, it's going down forever. And that's the bottom. Just like here, the third's the top. Once everyone believes either direction, because Marx talks a lot about investor psychology through the whole book, and he's saying that the fact that everyone believes it is what makes it go the other way. When you get to the point where everyone thinks that things are better and they're going to get forever, that forces the top. There's nobody new who can think things will get better to come in and push it higher, so that has to be the top. And at the bottom, equally, once everyone thinks that things are going to get worse forever and it's awful, then there's no one else to come in and think it get worse and sell more and get it lower. So that's the bottom. So another one he talks about a lot is contrarianism. And I'd probably say if you are a second level thinker, you've already picked up on this contrarianism idea through the others. It's a second order conclusion of all the things he's been saying the whole book. Where he's saying you cannot be doing what everyone else is doing if you want anything other than market matching returns. So in this chapter, he talks about, don't just do the opposite of what everyone else is doing for the sake of it, but you should almost be reassured if you've come to a different conclusion than everyone else. That should tell you that there's an opportunity to make money there. If you keep looking at a stock and every piece of news makes it go down, I'll say like this happened to me with Duolingo, where Duolingo did news of them doing things I wanted them to do that I thought made the stock more valuable, but every time that happened, Wall Street sold it off. And in my mind, that means the stock got more inherently valuable and it got cheaper. And that made me double down those bets, and those have returned plenty to me now. So here, buying when others are despondent and selling when they are euphoric takes immense psychological strength. Especially when you're in charge of other people's money like he was, and you have people trying to tell you what they think you should be doing, telling you when you're not just handling your own money and doing what you want, it's even harder. Michael Burry in The Big Short, where all of his investors are like, why are you shorting this? Why are you shorting this? We want to pull our money out. And if they pull their money out early, they're done. And he's run into that risk, with the .com bubble. A lot of these fund managers talk about how like all of the people under them want them to go in on the .com bubble, and it took a lot for them to not do it. The herd's usually wrong at extremes. They eagerly buy at the top and panic sell at the bottom. True contrarianism is lonely, uncomfortable, and looks foolish right up until the moment it works. And for him, it did work, and that's why he's got a best-selling book and everyone wants his stuff right after the 2008 financial crisis. So here are some excerpts from this chapter on why contrarianism is the most important thing. There's only one way to describe most investors: trend followers. Superior investors are the exact opposite. Superior investing, as I hope I've convinced you by now, requires second level thinking, a way of thinking that's different from that of others, more complex and more insightful. By definition, most of the crowd can't share it. Thus, the judgments of the crowd can't hold the key to success. Rather, the trend, the consensus view, is something to game against, and the consensus portfolio is one diverging from. As the pendulum swings or the market goes through its cycles, the key to ultimate success lies in doing the opposite. So I think that's explaining his general view. And he points out here that the whole book up to this point has been convincing you of this, not just this chapter. Investment success requires sticking with positions made uncomfortable by their variance with popular opinion. Casual commitments invite casual reversal, exposing portfolio managers to the damaging whipsaw of buying high and selling low. Only with the confidence created by a strong decision-making process can investors sell speculative excess and buy despair-driven value. And he's mentioning here, it's even harder for portfolio managers. A lot of them at the end of the year try and buy the things that already went up just to make it look like they held those things, and sell the things that went down so it doesn't look like they held those things. And then they're buying high and selling low by definition to appease all of the people who have a pull on them. Quote, "What's clear to the broad consensus of investors is almost always wrong. The very coalescing of popular opinion behind an investment tends to eliminate its profit potential. Take, for example, the investment that everyone believes to be a great idea. In my view, by definition, it simply cannot be so." So here he's saying basically the investor psychology of it, just like with the pendulum, how everyone being greedy forces the pendulum back. Here, everyone agreeing that an investment's a good investment means that it's impossible to get a good price. There's nobody who's going to be willing to sell it to you at a good price if everyone's in agreement that it's going to go up, right? You're going to have to overpay to get your hands on it, and that will eliminate your profit potential. Just like buying low increases your reward and lowers your risk, buying high increases your risk and lowers your reward. And you have to buy high to get it off of someone if everyone believes that it's going to be a good investment. So now for number 7, most important thing is knowing what you don't know. So in here, he talks about how it's impossible to know everything. It's impossible to understand everything about the entire world market. And especially, it's impossible to know more about the entire world economy than these hedge funds with thousands of people working on it, right? The more you zoom in, the more it's possible to have an informational edge. If you just learn everything there is to know about a single company or maybe an industry, particularly, Peter Lynch might say an industry you're involved in, then that does allow you to have an edge. So in this sense, he says macroeconomic forecasting is mostly a waste of time, even though I think in one of the next ones coming, he does promote a little bit of macroeconomic forecasting. Investors should instead focus on the knowable things: microeconomics, company fundamentals, balance sheets. Maybe you can understand the economy of a state better than you can understand the economy of the whole country, and you can make bets based on that with a bit more edge. Acting aggressively on confident but inherently inaccurate macro forecasts is a massive source of investment mistakes. So if you're going to bet on where you think oil prices are going and how that's going to impact the whole market or whatever, there's a lot more risk there. There's a lot more involved there that you might not know about. Others do. It's harder to have an edge because there's more information you have to wrap your head around. Now for some excerpts. Quote, "The more we concentrate on smaller picture things, the more it's possible to gain a knowledge advantage. With hard work and skill, we can consistently know more than the next person about individual companies and securities, but that's much less likely with regard to markets and economies. Thus, I suggest people try to know the knowable." So he's saying kind of throw out the idea that you can know everything. And the more you zoom in, the more it's possible to know everything. It's possible to maybe know more than 90% of people about let's say a whole country. It's possible to know more than 95% people about an industry, and it's possible to know more than 99% people about an individual company. And the more and more people who know more than you about something, the harder it becomes to make money. So another one. Quote, one way to get to be right sometimes is to always be bullish or always be bearish. If you hold a fixed view long enough, you may be right sooner or later. And if you're always an outlier, you're likely to eventually be applauded for an extremely unconventional forecast that correctly foresaw what no one else did. But that doesn't mean your forecasts are regularly of any value. It's possible to be right about the macro future once in a while, but not on a regular basis. So he's kind of taking shots at, I don't know if you know the Michael Burry meme of like Michael Burry's predicted one of the, or like 25 of the last one crashes, whatever it is, right? Where he's just always saying things are going to crash, and he was right once and they made a movie about him. That's kind of what he's saying here. If you're always going to make crazy predictions, you will be right once in a while, but that does not mean your predictions have any value. It just means a broken clock's right twice a day. The last one, quote, the biggest problems tend to arise when investors forget about the difference between probability and outcome. That is, when they forget about the limits on foreknowledge. When they believe the shape of the probability distribution is knowable as certainty and that they know it. When they assume that the most likely outcome is the one that will happen. When they assume that the expected result accurately represents the actual result. Or, perhaps most important, when they ignore the possibility of improbable outcomes. So this is going back to what he talks about of like more things can happen than will happen. An unlikely outcome can happen and a likely outcome can not happen. And that's where you have to know that what you don't know. You have to understand that even though you know something's likely, that doesn't mean you're going to be right. Even if you know there's a 95% chance something will happen, you can't just assume it will happen. I've done game design, and there's always a thing where if you put like a 95% chance, people assume that means 100% chance. And if you put a 5% chance, people think that feels like a 20% chance. So, people aren't really good at judging percentages versus actual outcomes or understanding that unlikely events can happen. They're very, very bad at judging that. So on to the next one, which is recognizing your environment, where he talks about how you should keep an eye on the macroeconomic situation. So here he says, that we can't predict the future, but we can understand our present conditions. We can understand where you stand at the moment. Take the temperature of the market. Are investors acting recklessly or terrified? Is credit easy? Is credit tight? And then manage and adjust your portfolio's aggressiveness or defensiveness based on the current market environment. So since you know that the pendulum moves one way or the other, if you can get a sense, you might not know when it's going to reverse, how far it can go, how hard it's going to reverse, but you should be able to get a sense of which side of the pendulum things are on right now, and you can adjust your footing accordingly to be ready. Don't totally go all in one way or the other, but maybe change from like 60-40 aggressive defensive, and swap back and forth based on. You can tell if the market's greedy or fearful at the moment, even if you don't know how much more greedy it can get, how much more fearful it can get, if it's going to change on Tuesday or if it's going to change in 2 years. But you can know that the risks are higher than normal, or that the prices are lower than normal, and behave accordingly. So here are some excerpts. Quote, so what can we do about cycles? If we can't know in advance how or when the turns will occur, how can we cope? On this, I am dogmatic. We may never know where we're going, but we'd better have a good idea of where we are. That is, even if we can't predict the time and extent of cyclical fluctuations, it's essential that we strive to ascertain where we stand in cyclical terms and act accordingly. So that's basically what I just said. That just explained his whole concept in a nice little short paragraph there. Another one, quote, it would be wonderful to be able to successfully predict the swings of the pendulum and always move in the appropriate direction, but that is certainly an unrealistic expectation. I consider it far more reasonable to try to A, stay alert for occasions when a market has reached an extreme, B, adjust our behavior in response, and C, most importantly, refuse to fall into line with herd behavior that renders so many investors dead wrong at tops and bottoms. So he's saying that it would be wonderful if you look back to always buy the bottoms and sell the tops, but you can't do that. But you can adjust, and you can definitely avoid going all in at the wrong time. You can avoid buying the top, and you can avoid selling the bottom, even if you can't always buy the bottom and sell the top. Final one, quote. So look around and ask yourself, are investors optimistic or pessimistic? Do the media talking heads say the market should be piled into or avoided? Are novel investment schemes readily accepted or dismissed out of hand? Are securities offerings and fund openings being treated as opportunities to get rich or possible pitfalls? Has the credit cycle rendered capital readily available or impossible to attain? Are price earning ratios high or low in the context of history? And are yield spreads tight or generous? All of these things are important, and yet none of them entails forecasting. So, and I think you could say right now that the market is in a greedy cycle, but you could also say that like the performance of the market and the earnings growth as the Mag 7 take up more and more of the market, it is justifying perhaps this behavior. But definitely, if you looked at all of these, you would say we're in a greedy area, even if there was just a sell-off last week or whatever. But in general, the market's in a pretty greedy mood right now. And I think on all of these, you would be saying that we're on the greedy side right now. And it's worthwhile to have some defensive assets. I have a good chunk of money in gold. I have a good chunk of money in Berkshire. You know, those are things that if the market crashes, will be fine. I have some boring telecommunications, stuff like that has such a margin of safety that if the market crashes, those will be fine. Those can't go much lower. I got a lot of company for my money, right? So now for another one, appreciating the role of luck. This, once again, as we get further on, these talk about a lot of concepts that we've talked about a lot up till now. And that is that it's hard to tell the difference between someone who just got lucky or someone who was right. It's also that underneath all of this financial industry, you are fundamentally making bets. It's a little bit of a casino. There's dice rolling. People are chances determining a whole lot of things. So it says alternate histories matter. Just because something worked out doesn't mean it was fundamentally a good decision. You can make a wrong decision and be right, or you can make a right decision and be wrong. And it's hard to just look back at results and say who made the best decisions. Short-term success can be entirely due to luck, masking a highly flawed investment process, and over a long enough timeline, luck evens out, and true skill should finally be revealed over the course of decades. You know, the people who are making crazy bets and 10xing their money are also risking that they could go to zero, and over a long enough time, they're going to mess up, and they'll end up right back where they started, even if they have some amazing days in the middle. So here's some excerpts from this, including a table he presented that I'll get to. So, quote, $10 million earned through Russian roulette does not have the same value as $10 million earned through diligent and artful practice of dentistry. They are the same, can buy the same goods, except that one's dependence on randomness is greater than the other. To your accountant, though, they would be identical. Yet deep down, I cannot help but consider them as qualitatively different. And the reason why is that even if you made $10 million through Russian roulette in the last year, and a dentist made $10 million through dentistry in the last year, are you going to be able to keep doing that? Are you going to do that next year and the year after? The dentist, he can keep making that $10 million every year on year, pretty reliably. But if you keep playing Russian roulette, it's going to go against you and you're going to be in trouble, and you're not going to be able to keep doing that for years and years to come. So here's a quote from Warren Buffett, Warren Buffett's Attachment to the Intelligent Investor, added into this book. But I thought it was really good. I thought it was a really good example of how luck can be mistaken as skill, and often is in our market. You could even say that all these great investors, everyone, an efficient market hypothesis person would say this is what's actually going on with the market for everyone. Every successful investor is like this example. So Warren Buffett's appendix to the fourth revised edition of The Intelligent Investor describes a contest in which each of the 225 million Americans starts with $1 and flips a coin once a day. The people who get it right on day one collect $1 from those who are wrong and go on to flip again on day two. So then you have 112 million people, and they each have $2, and the rest have zero because they flipped wrong. Okay, and so forth. 10 days later, 220,000 people have called it right 10 times in a row and won $1,000. They may try to be modest, but at cocktail parties, they will occasionally admit to attractive members of the opposite sex what their technique is and what marvelous insights they bring to the field of coin flipping. After another 10 days, we're down to 215 survivors who've been right 20 times in a row and each have won $1 million. They'll write books titled How I Turned $1 into $1 Million in 20 Days, working 30 seconds a morning and selling tickets to seminars. Sound familiar? And once again, an efficient market person would say that's what Warren Buffett is. Warren Buffett's just the guy who flipped right 20 times in a row, and he doesn't know anything more than anyone else. Some people are bound to win, some people are bound to lose, and looking back, you're mistaking their luck as their skill. So this was a table he showed, and this was from another book he read about randomness in the market. He was quoting this book for the whole thing, but I thought this was an interesting table. And it was saying that in hindsight, things on the left can very easily be mistaken for things on the right. And it's very hard to tell them apart in hindsight. So luck can be very easily mistaken for skill. Randomness can be very easily mistaken for determinism. So once the person who made the bet on a 2% chance outcome in was right, you wouldn't think, oh, wow, they just got lucky and got a lucky 2%. You'd say, wow, they knew something no one else did, and they knew it was going to happen. Probability in hindsight can mistaken as certainty, similar reason. Belief and conjecture can be mistaken for knowledge and certitude in hindsight. Theory and reality can be mistaken. Anecdote and coincidence can be mistaken as causality in law. Survivorship bias can look like market outperformance, just like the coin flippers, right? Those would all look like they're the most genius guys who can flip a coin how they want every day, and it's just they're bound to be 200 people after 20 days with that much money, just statistically, right? And a lucky idiot in hindsight can look like a skilled investor. And all of this sort of muddies the water when you're looking at hindsight and trying to find good advice, that it's hard to tell the difference between someone. And that he talks about this all the time. It's impossible to tell risk in hindsight. It's impossible to tell skill in hindsight. And you look very deeply and deeply understand things if you want to be able to tell those things apart from each other. So the final one, his most important thing, is defensive investing. He talks, once again, this is combining a few chapters here. So investing is often a loser's game, not by hitting home runs, but by systemically avoiding mistakes. The core strategy must be focused on capital preservation first and capturing upside second. And once again, this is coming from someone who did well after two once in a lifetime market crashes. And that's his opinion, but you will go through in your lifetime a few once in a lifetime crashes. More than one, even though that's what they call them. So it is good advice. And then avoiding massive drawdowns allows the math of compound interest to work uninterrupted over decades. If you have a year where you're minus 40%, it's going to take you years and years to make that back. But if you only went down 10%, then it's barely going to interrupt you, right? So here are some excerpts from his sections on investing defensively and avoiding pitfalls. The critical element in defensive investing is what Warren Buffett calls margin of safety or margin of error. This subject deserves considerable discussion. It's not hard to make investments that will be successful if the future unfolds as expected. There's little mystery in how to profit under the assumption that the economy will go a certain way, and particular industries and companies will do better than others. Tightly targeted investments can be highly successful if the future turns out as you hope, but you might want to give some thought to how you'll fare if the future doesn't oblige. In short, what is it that makes outcomes tolerable even when the future doesn't live up to your expectation? The answer is margin for error. And this is why he's partially a deep value investor. He's saying that you need to have so much price that you have to be buying into things at such a low price that even if everything goes wrong, there's still a good chance that you make money. It's sort of the Manish Pabrai, like heads I win, tails I don't lose much, along with him saying here that if all of your investments are in the idea of one thesis coming out true, if all of your investments are that the AI bubble will pop or that the AI bubble is real, that you need to accept, no matter how sure you are, there's some chance that you're wrong, and you need to have some understanding of how you're going to be fine even if you are wrong, or accept the losses. And he's saying, well, if you bought them all at such absurdly good prices, then it shouldn't even matter. I'm actually not an Adobe person. Let's say Adobe, where it's so stupidly cheap that even if the bears are right and AI destroys the business, that you still got in so cheap that you still make money, right? Something like that, where just getting absurd deep value, absurd margin of safety that can also protect you from being wrong, or diversifying the outcomes, as he said in the other one, diversifying the amount of scenarios that your portfolio would be fine, and make sure your portfolio is fine if AI does go crazy, and also it's fine if AI ends up being a nothing burger, right? So here's one where he's talking about his belief on defensive investing being what lifts his fund above others. Oaktree's preference for defense is clear. In good times, we feel it's okay if we just keep up with the indices, and in the best of times, we may even lag them a bit, especially right before bubbles. He was surely lagging them a bit. But even average investors make a lot of money in good times, and I doubt many managers get fired for being average in up markets. Oaktree's portfolios are set up to outperform in bad times, and that's when we think outperformance is essential. So the reason he outperformed the market, the reason he gets 19% annualized instead of 8 to 10% annualized, is because when the big falls happen, they don't fall. Even if they went up a bit less than everyone else, they definitely don't fall as far as everyone else. And then especially, as he says elsewhere, then they have money to buy the dip when they're buying from forced sellers, when people are getting liquidated, when people are terrified and think that it's gone down 50% and it's about to go down another 50%, they're there ready to buy it up. When the CDOs are crashing, they're in a position to buy them up. And they can get both ends of not falling as far and catching the recovery harder than other people, even if the build up to the bubble they did not catch as much as everyone else. And then the final one, quote, there are two principal elements in investment defense. The first is the exclusion of losers from portfolios. This is best accomplished by conducting extensive due diligence, applying high standards, demanding a low price and generous margin for error, and being less willing to bet on continued prosperity, rosy forecasts, and developments that may be uncertain. The second element is the avoidance of poor years, and especially exposure to meltdown and crashes. In addition to the ingredients described previously that help keep individual losing investments from the portfolio, this aspect of investing defense requires thoughtful portfolio diversification, limits on overall riskiness borne, and a general tilt towards safety. So on the one hand, putting in the extra legwork, the extra time, the extra effort to research the things you're owning and make sure that they don't throw up red flags, getting as many red flags out of your portfolio as possible, things bought expensively, things with bad management, things with bad moats, whatever. The less red flags in your portfolio, the better. The better prices you get, the better. And then on top of that, things like diversification and buying safer assets and avoiding the big hot assets of the day. In combination, those are what allow him to defensively invest. Because a lot of people might say just pull out of the market, and I don't think he's a pull out of the market guy. He's just ignore the market being crazy, buy things that you're sure are good in any weather, and that will protect you in the downfall. Even if there's no way to not get it. If the market crashes, surely everything crashes, and he'll be down 20%. But if everyone else is down 50%, that's fine. So I believe that is the end of the presentation. If you guys like it, please subscribe. I'm going to do more of these. It's going to be harder for me to push out these. I was already almost done with this book when I posted the video about the last book. So I'm going to have to pick another book. If you guys have any book recommendations, let me know. I'm going to also do some of the more quick and easy videos. These ones are pretty effort heavy. I read the book twice over. I did a 25 slide presentation. I had to record all of this. But I'm probably going to try and find some quick and easy things I can do where I just talk about a stock I know a lot about, or research some new stock, or talk about whatever. I have some ideas for stuff we can talk about with Buffett or whatever. So I'm going to try and get out like one kind of effort video a week and then one more quick and easy video a week. And this is obviously the effort one. I'll try and do more book reviews. I really like these, but there's not going to be one next week because I have to read a full book and then make the thing. But thank you guys. I appreciate the love. Please comment. Please subscribe. Please keep watching. Let me know what you want to see, or any stocks you want me to look into or talk about. Anything you want to know about my portfolio or whatever. But I've been filling out a whole Word document every time I have an idea for a video. I've been filling that out. So hopefully I'm not going to run out of ideas, and I can just, if I'm ever out of content, quickly record one of the easier ones. I have a list of books I want to get to. There are books I've already read that I could do this on, but I'd still have to review those books. These are all books that I finished the week before posting or 2 weeks before posting. So anyway, thank you guys. I appreciate all of the love the last video got. And thank you guys so much for watching. And it feels great to know that people, I guess, value what I have to say. I've been obsessing over the stock stuff for like 2 years at least. And I'm glad to see that people are interested in what I've learned, I guess. So have a great day, everyone.